Meet John. He's 28 years old. He works as a mid-level accountant in Chicago. He makes $32,000 a year. It's 1985. Now meet Sarah. She's also 28 years old. She also works as a mid-level accountant in Chicago. She makes $75,000 a year. It's 2024. Adjusted for inflation, they make the exact same amount of money. There are many Johns and so many Sarahs. John is buying his first home. A 3-bedroom house in a decent neighborhood costs $80,000. His mortgage payment is $650 a month. That's 24% of his income. He saves for 2 years, puts down 10%, and the bank approves him in a week. Sarah is trying to buy her first home. That same 3-bedroom house in the same neighborhood now costs $420,000. Her mortgage payment would be $2,800 a month. That's 45% of her income. She's been saving for 6 years and still doesn't have enough for a down payment. Even if she did, the bank says her debt-to-income ratio is too high. She has $65,000 in student loans. John had none. One of them will own a home, and one of them won't. They worked just as hard. They made the same money. So what changed? I'm Malcolm, and this is History Meets Economics. If this is your first time, take a moment to subscribe to the channel and turn on notifications. Now let's start with the down payment, because this is where the math gets cruel. If John wants a house, John just needs to save 10% for his down payment. That's $8,000. On his $32,000 salary, he's saving about $300 a month after expenses. 27 months later, he has his down payment. He's 30 years old when he buys the house. Sarah, on the other hand, needs to save 20% for her down payment, because after 2008, that's what lenders want. That's $84,000. But Sarah also has student loans, $65,000 of them. Her monthly payment is $650. She's paying $1,800 a month in rent because she can't live with her parents. They're in a different state. After taxes, rent, student loans, food, transportation, and basic living expenses, Sarah can save about $400 a month, if absolutely nothing goes wrong. At that rate, it would take her, hold your breath, 17 and a half years to save $84,000. She'd be 45 years old. But housing prices don't wait. While Sarah saves, prices keep rising. In 2020, that same house cost $380,000. By 2024, it's $420,000. By the time she saves $84,000, the house will cost $460,000. Her target keeps moving. It's like running a marathon, and when you can almost see the finish line, it gets moved farther. Every year, Sarah saves $4,800. Every year, the house she wants gets $8,000 more expensive. She's literally losing ground while doing everything, every single thing right. John's target? Sat still. Sarah's runs away from her. And when something breaks, a car repair, a medical bill, helping a family member, Sarah's savings get wiped out. She starts over. John never had to worry about that. His emergency was the down payment. Sarah's emergency is everything else, while also trying to save the down payment. This isn't just Sarah. By 2024, 36% of millennial and younger homebuyers needed family help to cover their down payment. That's double the rate from 2019. If your parents have money, you can buy a house. If they don't, you probably can't. That's the new math. So how did we get here? What happened between John's world and Sarah's? September 15th, 2008. Lehman Brothers collapses, the global financial system freezes, credit markets seize up, unemployment explodes from 5% to 10%. 8 million people lose their jobs. 6 million families lose their homes to foreclosure. It's the worst economic crisis since the Great Depression. The Federal Reserve does something it has never done before. In December 2008, they cut interest rates to 0. Not 1%, not 0.5%. 0. Emergency measures to save the economy and prevent total collapse. But then they left rates at 0 for 7 years. They also launched quantitative easing, buying up bonds and mortgage-backed securities. The Fed's balance sheet exploded from $870 billion to $4.5 trillion. The goal was to pump money into the economy, make borrowing cheap, get people spending and investing again. And it worked. The economy recovered. But something else happened too. Something nobody fully anticipated. Sarah graduates college in 2010. The job market is a disaster. She sends out 200 applications. She gets 3 interviews. One company ghosts her. One offers an unpaid internship. The third offers $15 an hour, part-time, no benefits. She takes the internship. works at a coffee shop on weekends, moves back in with her parents because she can't afford rent. This isn't what she planned. She has a degree. She did everything right. 2 years later, she finally gets a full-time job, $45,000 a year. It's $20,000 less than what people in her field made before the recession. But she's grateful. At least it's something. She's already behind. She spent her prime wealth-building years underemployed. She couldn't save. She couldn't invest. The compound interest clock that started ticking for John at 28 doesn't start for Sarah until she's 32. 4 years. Gone. John didn't have to deal with any of this. He graduated into a booming economy. He got hired immediately. He started building equity at 30. By the time the 2008 crisis hit, John was 51 years old. His house was paid off. He was fine. But here's where the Fed's response gets interesting. Those low interest rates that were supposed to help everyone, they helped some people a lot more than others. With rates at zero, real estate became the best investment in America. Institutional investors, private equity firms, hedge funds, real estate conglomerates started buying houses. Tens of thousands of them. In 2011 and 2012, firms like Blackstone started buying foreclosed homes by the thousands. Phoenix, Las Vegas, Atlanta, Miami, they'd buy entire subdivisions. 20 houses, 50 houses, 100 houses. They could pay cash. They could outbid people who needed mortgages. They could afford to overpay because they were playing a long game, and every house they bought was one less house for Sarah. One less house for first-time buyers. One less house for families trying to build wealth. They turned homes into assets, shelter into returns on investment, communities into portfolios. Meanwhile, lenders tightened the rules. Credit scores required for a mortgage jumped by about 100 points. Down payment requirements increased. Income verification got more intense. It made sense. Lenders had just watched millions of mortgages default. They were scared. But it locked out an entire generation of first-time buyers. By 2019, just 33% of millennials owned homes at age 30. For Gen X at the same age, 42%. For baby boomers, 48%. Then March 2020 happens. The world shuts down. The Fed looks at its 2008 playbook and does it all again, but bigger. Rates go to zero. The Fed starts buying $120 billion per month in bonds and mortgage-backed securities. Unlimited stimulus. Mortgage rates collapse to the lowest levels in American history. January 2021, 2.65% for a 30-year fixed mortgage. If you already owned a house, this was incredible. You could refinance and cut your monthly payment by hundreds of dollars. Free money. Sarah sees those low rates and thinks maybe this is her chance. She's been saving. She has $40,000 for a down payment. Not the full 20%, but with rates this low, maybe she can make it work. She starts looking at houses. And that's when she realizes everyone else had the same idea. Houses are going under contract in 48 hours. Multiple offers on everything. Bidding wars, driving prices, $30,000, $50,000, $80,000 over asking. Sarah puts in an offer on a house listed at $350,000. She offers $360,000. She gets outbid by someone offering $390,000 cash. She tries again. Same thing. Third time. Same thing. Fourth time, she offers $380,000 on a house listed at $365,000. She waives the inspection. She writes a personal letter to the sellers about how much she loves the house, how she'll take care of it. Someone offers $410,000. All cash, close in 2 weeks. She loses again. The low rates created a feeding frenzy. Prices exploded. By the end of 2021, that $350,000 house costs $420,000. Sarah's $40,000 down payment suddenly isn't enough. She's back to square one. The lowest mortgage rates in history coincided with the least affordable housing market in history. If you already had a house, you won. If you didn't, you got crushed. February 2022. Inflation hits 7.9%, the highest in 40 years. The Fed panics. They start raising interest rates faster than they have since 1994. March 2022, rates go up. June, up again. July, the Fed raises rates by 0.75%, the biggest single hike in 28 years. Then they do it again, and again, and again. By October 2023, mortgage rates peak above 7%. Let me show you what that means in real dollars. A $400,000 mortgage at 2.65%, monthly payment of $1,612. The same $400,000 mortgage at 7%, monthly payment of $2,661. That's a difference of $1,049 every single month. $12,588 a year. Over 30 years, that's an extra $377,640 in interest. Same house. Same loan. The only difference is when you were born. Sarah is 37 now. She's been trying to buy a house for over a decade. She's saved more money. She makes more money. She's done everything right. But at 7% interest, she's priced out again. That $420,000 house, her payment would be $2,800 a month. Add property taxes and insurance, and she's looking at $3,500 a month. That's 56% of her gross income. No bank will approve that. And here's the cruelest part. Even if prices dropped, the market is frozen. Because everyone who owns a house has a 3% mortgage. They're not selling. Why would they? If they sell and buy a new house, they'd have to trade their 3% mortgage for a 7% mortgage. Their monthly payment would double, so they stay put. It's called the lock in effect. And it means there are almost no houses for sale. Housing inventory is at historic lows. Prices stay high because supply is strangled. Sarah is competing for scraps. So where are we now? January 2026. The Fed has cut rates 3 times in late 2024. Mortgage rates have come down a bit, around 6% now. Better than 7, but still double what they were in 2021. Housing inventory has improved for 25 straight months. There are more houses for sale than there were in 2022. Progress. But Sarah still can't afford a house. Neither can millions of people like her. She's not alone in this. Talk to anyone under 40 trying to buy a house right now. They'll tell you the same story. Endless searching. Constant rejection. Watching their down payment savings get eaten by inflation. Competing against investors, against people whose parents gave them money, against dual income couples who both make 6 figures. It's exhausting. And it's rigged. To afford a median-priced home in America today, you need to earn $111,000 a year. That's a 50% increase from just 4 years ago. 75% of the top 100 housing markets are still overvalued. The millennial homeownership rate in 2024, 54.9%. Barely budged from the year before. Meanwhile, surveys show that 4 out of 5 potential home buyers are waiting for rates to drop before they buy. A quarter of them want rates below 5%. Experts say that's not happening anytime soon. Maybe not ever. The 2.65% rates of 2021, those were an emergency measure during a global pandemic. Not normal. Not coming back. So an entire generation is waiting for something that's never going to happen. Let's go back to John and Sarah one more time. John bought his house in 1985 for $80,000. In 2024, that house is worth $420,000. He's accumulated $340,000 in equity. Just by existing. Just by being born at the right time. It looks worse in 2026. That $340,000 equity is wealth. It's collateral. He can borrow against it. He can help his kids buy a house. He can retire comfortably. Sarah is still renting. She's 38 years old. Over the past decade, she's paid roughly $216,000 in rent. $216,000. Think about that number. If she'd been able to buy a house 10 years ago, that money would have built equity. It would be hers. Instead, it's gone. It paid her landlord's mortgage. It built her landlord's wealth. That money is gone. She has nothing to show for it. John's wealth, $340,000. Sarah's wealth, 0. But it's not just the number. It's what that number means. John can retire. He can help his kids with college. If his daughter wants to buy a house, he can give her $50,000 for a down payment and barely feel it. He has security. He has options. Sarah has none of that. If she loses her job, she's 3 months from being broke. She can't help anyone because she can barely help herself. She'll be working into her 70s just to survive. Same job. Same inflation-adjusted income. Different birth year. This is not a small problem. Housing wealth is how middle-class Americans build wealth. It's how you fund retirement. It's how you help your kids. It's how generational wealth gets passed down. And millennials, the largest generation in American history, are getting locked out of it. But it gets worse, because the people who can buy homes now, they're not doing it alone. Remember, 36% of millennial home buyers needed family help for their down payment, up from 18% in 2019. If your parents have wealth, you can get into the market. If they don't, you're on your own. Good luck. The 2008 crisis didn't just create a recession. It created a permanent wealth divide based on when you were born and whether your parents could help you. But the question is, who's responsible for this? Who is to blame? Is it the Federal Reserve? They slashed rates to save the economy, but those low rates also fueled investor buying and housing speculation. They kept emergency policies in place for years, inflating asset prices while millennials were still recovering from the recession. Is it the banks? They crashed the economy with reckless lending, then overcorrected by making it impossible for regular people to get mortgages. They got bailed out. Millennials didn't. Is it institutional investors? Private equity firms and hedge funds buying up tens of thousands of homes, treating housing as a financial asset instead of a place for people to live? Is it policymakers? They could have built more housing. They could have restricted investor purchases. They could have reformed zoning laws. Instead, they watched as corporate landlords bought up entire neighborhoods. They watched as NIMBYs blocked every new apartment complex. They watched as single-family zoning laws, literally designed in the 1920s to keep neighborhoods segregated, prevented dense, affordable housing from being built. They didn't just fail to act. They actively protected the system that was breaking. Is it older generations, baby boomers and Gen X, who vote against new housing construction because it might lower their property values? They got theirs. Pull up the ladder. The answer is all of them. And none of them. Because the truth is, this wasn't a conspiracy. It was a cascade of decisions, emergency responses to a crisis, tightened lending standards to prevent another crash, monetary policy trying to restart a frozen economy. Each decision made sense in isolation. Together, they created a system that locked out an entire generation. John and Sarah did everything the same. They went to school, they got jobs, they worked hard, they saved money. But John was born in 1957. Sarah was born in 1986. John bought a house when he was 28. He built $340,000 in equity. He's financially secure. Sarah is 38. She's still renting. She's still saving. It doesn't look like it's ending soon. She's still waiting for a market that might never be affordable again. The American dream didn't die. It just became a lottery based on your birth year. So yeah, that's what changed. The 2008 crisis didn't just crash the housing market. It restructured the entire economy in ways that benefit people who already had wealth and punish people who were just starting out. And unless something fundamental changes, unless we build millions more homes, unless rates stabilize at affordable levels, unless we stop treating housing as an investment vehicle first and shelter second, this is the new normal. This is what America looks like now. If you were born at the right time, before the crisis, you're probably fine. You bought cheap. You built wealth. You're set. If you were born after 1980, good luck. You're starting from behind. The ladder's been pulled up. The door's been closed. A generation of Sarahs locked out. A generation of Johns grandfathered in. And the worst part? People who already own homes benefit from high prices. They vote to block new construction. They oppose zoning reform. They want their $340,000 in equity to keep growing. Their wealth depends on your exclusion. Your inability to buy is their retirement fund. Same work, same money, different outcome. Welcome to Housing in America. I'm Malcolm, and this is where history meets economics. Subscribe now. If you think this documentary is wrong, explain where. If you think it's right, explain. Here's another moment where history met economics.